First with Rio, really the crux of it is it's going to have a very strong cash flow and earnings result. I mean, that's more than baked into the market at this point, I think. But what we're really waiting for, and what we've been talking about for a little while now, is where consensus sits on the dividend versus what they're actually likely to pay. So you'll remember back to the start of the year when we had a presentation from Chris Lynch, the CFO of Rio, and he was pretty much winking and saying that, we're going to reward shareholders for supporting the company, and especially with this big increase in cash flow and low capex that the business has. So consensus is forecasting a dividend payout ratio of just over 50%, which I think is ludicrous when you consider that their framework allows for 40 to 60% payout, and they really don't have any big capex items. So even just forecasting the top end of that payout ratio, you get US $1.41 for the dividend for this result, and then I think that there's up to a further $2 billion or just over $1 a share they could put into either a special dividend or enlarge the buyback they've got. So that's what we're waiting for. That'll come out just after market, so we'll have some more feedback tonight. Just moving on to the rest of the sector, the year that was in resources was obviously a positive year in FY17, and that was obviously driven in large part by the price action we had across commodity indexes. Iron ore was the big one. You'd see there on the chart we've got that it's been on a wild ride, but all of it's been positive, and that's the chart on the left. The iron ore price averaged $70 per tonne in FY17 versus $50 per tonne the year before. So that's $20 per tonne. When you couple it with the costs that we had across the majors and the low capital intensity of their businesses at that time, does equate to huge cash flow. So expecting that to really support the results like Rio, BHP, Fortescue, where at a minimum it's a 50% exposure to their earnings. Base metals as well, that's been less covered in the market until more recently, where they started to really pick up again. But they also have been all trending higher, except for nickel, which has been lagging. So that also is another big kick along for the majors, but also for some of the small and mid caps. From all of that, what we distill is the fact that the profitability across the sector has really surged and gone through the roof. Cash flow yields are really back at cyclical highs, which is a real positive, and the sector's in great shape. So really some of the key themes for this reporting season will obviously be that price strength. That's going to offset some disappointing operational results we've had out of companies like Rio and South32, and really plug those gaps and still put towards big cash flow numbers. The capital discipline, I think that's going to stay in place this reporting season. I don't think you're going to see these companies really parading growth outside of the small brownfield expansions the large caps have been parading around the market in mining. I really think that all stems from low business confidence, whereas in the small and mid-cap space, which the guys will talk on in a minute, that's really driven more by an access to capital, which has obviously been improving for the space. So I think they'll be much more active and probably much more of a highlight over the coming months. And then capital management, which I've talked about. So really the key contenders for capital management surprises, Rio, BHP, obviously number one. Then behind that, you've got Fortescue and South32. So they're all going to have really good cash flow numbers, and we'll just have to wait and see how much they choose to put that into dividends. So FY17 was a great year. Does that mean it's all over at this point? There's a question that gets put to us all the time in the resources team. Really, I believe we're in a multi-year recovery phase for the sector, and that started at the start of 2016. What's driving that view for me is the fact that even though everyone points to, all the bears point to supply fundamentals as the key detractor, but that was true in iron ore at the start of last year, where there's this insurmountable surplus in the market, but we still saw the iron ore price rise almost 100%. And what drove that? And what drove it was demand, and that's what we're really starting to see pick up now in the global macro scene. So Knox is talking about it all the time when he refers to resources, the fact that the demand indicators are actually quite positive across metals, and you really see it here. So these two charts are a global consensus changes in GDP for different key consuming regions and industrial production. So they're the two big macro indicators. These are all the big countries that are very commodity intensive, and you'll see expectations are really starting to surge now. So for me, it is a simple fact that while supply fundamentals can sometimes be uninviting in some metals, it's really going to be demand that starts to set the tone for the next phase of the cycle. And that is that, and this is a good chart that Tom Sartor put up, that the simple fact that while the global macro growth picture has been improving, only really equities are being rewarded for it, not so much commodities in a relative sense. So we certainly don't see commodities as being expensive at this point. But it is important to remember these aren't industrials. The resources are very cyclical, and not only do cycles turn, but you also get individual commodities and individual miners overshooting on the upside and the downside as the cycle progresses. So a good example of that is iron ore, where it's already at $70. Our long-term sustainable forecast for iron ore is $60 per tonne, and Fortescue's quickly raced up to our price target where it was a big discount. So that is a typical stock where you're not just going to set and forget. You're going to have to remain more active around the position than you would your typical large cap. And just to revisit our top picks, really BHP and Oil Search are my top buys. Oz Minerals, we also see great value. Rio and Fortescue have run a bit hard and both either at or beyond our price targets now. Categories where we see great names for taking profits or switching out of. South32 and Fortescue, definitely taking profit territory for me now. Switching out of Origin, Woodside, Newcrest, just see all those stocks not offering great value, not drastically expensive, but certainly not cheap. So great opportunity to switch. And Santos, where I've got to sell/avoid. Obviously, the oil price is going to dictate their future. I've been through that in great detail, but just think you shouldn't be there. It's just too much risk for our typical investor.